This is Nightly Business Report with Bill Griffith and Sue Herrera.
Trade turnaround. There are conflicting reports tonight that the U.S. is thinking about easing tariffs on Chinese imports, and stocks wasted no time reacting. Binge watch. Netflix revenue was not as strong as Wall Street had hoped, and that took some air out of the stock that has been on a tear recently. Rising risks. Could extreme weather trigger a foreclosure crisis? Tonight, a close look at the potential threat. Those stories and much more tonight on Nightly Business Report for this Thursday, January the 17th. And we do bid you a good evening, everybody. Sue is off tonight. The stock market lately has become like a coiled spring, especially when it comes to trade issues. Witness what happened today. There was no official government release about the ongoing negotiations between the U.S. and China, but there was a report midday from the Wall Street Journal saying the U.S. officials were debating whether to ease tariffs on Chinese imports. And that spike in stocks was immediate, as you can see. Trade-sensitive names like Boeing and Caterpillar led the way higher. But some of those gains were soon pared back when CNBC reported that neither the Treasury Secretary nor the U.S. Trade Representative had made any recommendations with respect to tariffs by the close. At the close, the Dow was up 162 points. As it happens, it was near the high of the day. The Nasdaq was up 49, and the S&P 500 added 19. Now, when investors saw that sudden midday rally in stocks, many of them did not want to miss out. And that's the way the thinking has been taking hold lately on Wall Street. Bob Pisani explains.
The markets have a new fear, FOMO, or the fear of missing out on the rally. The old fears haven't gone away. Tariffs and China's slowdown, Fed aggressiveness, all those issues are still out there. But as we've got into the heart of earnings season, the markets have again resumed their upward drift. So why is this happening? First and foremost, the fear that earnings growth would go to zero in 2019 has largely abated. Earnings expectations are lower, but most still are expecting gains in the mid-single digits rather than zero or negative earnings growth. For the first quarter, for example, earnings growth expectations have gone from 8% growth on October 1st to just 3% today, but the rate of decline has slowed down. Second, the market is considerably cheaper than a few months ago. Even with a 10% rally, the S&P is trading roughly 15 times 2019 earnings. That's the low end of the historic range, and it's well below the roughly 17 to 18 level it was during the heights of last year. Another factor is declining volatility. This has made momentum following trends, for example, more comfortable with getting back in. Finally, there's FOMO, as I mentioned, this fear of missing out. With the S&P unexpectedly up 5% in the first half of the month, fund managers are again underperforming. Those fund managers underperformed last year in a down market. Now the opposite has happened, and they can't afford to underperform in an up market as well. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, while some investors are fearful of missing out on any stock market rally, there are those who are keeping a close eye on another key financial market, namely U.S. corporate bonds. Companies today carry a $9 trillion debt load, and that is twice as much as they did 10 years ago at the height of the financial crisis. What does that signal about the economy? Joining us tonight is Kathleen Gaffney. She's Director of Diversified Income with Eaton Vance. Kathleen, good to see you. Thanks for joining us tonight.
Thank you. Great to see you, Bill.
I guess it would make sense for companies to issue more debt over time when we were enjoying record low interest rates, right?
Absolutely.
Were you surprised at how much debt they took on, though?
Well, it is, I would think, a normal response to interest rates moving lower. And as long as the companies can still pay the bonds back, that's not a problem.
We have a chart we can show that was put together by a money manager that is based on information from the Federal Reserve and the Commerce Department and the Wall Street Journal. And it shows the rise and fall of corporate debt as a ratio of corporate debt to the size of the economy going back to the 1980s. And each time there was a peak in that ratio, the economy went into a recession every single time. Now we seem to be at a peak again. Are you concerned about the level of the debt, its relationship to the economy, and the possibility of a recession?
I am not overly concerned about the amount of debt because the interest rate that companies are paying is so low right now. The leverage to the economy is definitely something to keep an eye on, but that's more relevant for assessing the country risk. Is the U.S. government going to be able to pay back their debt? With corporate bonds, you are lending money to corporations. And in the investment grade market, most of these companies are household names and very solid credits. They've been borrowing at lower interest rates and borrowing at the very long end of the yield curve. That means that they aren't going to have to pay off that debt tomorrow.
Right.
So they have time to grow into that. So I'm not worried about a systemic problem in the market, but I do recognize it has definitely grown by leaps and bounds.
Are there sectors that you think are good or attractive right now in the corporate bond market for people who may be looking for income right now?
Oh, gee, the positive side of interest rates moving higher is that income levels will move higher too, and that's great for savers and people living on a fixed income.
Right.
But we're coming off of what was essentially the zero bound. And what the Fed is trying to do is just get the level of interest rates at the short end, which is basically the price of money. What does it cost to borrow in the corporate bond market? And getting back to a normal level, which would reflect a healthy level of inflation and a healthy growth rate,
right,
is where they're headed. We have a ways to go before we get there. So there's still a fair amount of stimulus being provided. I wouldn't say that the Fed is trying to tighten.
Right.
It just means the cost of money is going up.
All right. Kathleen Gaffney with Eaton Vance, thanks for joining us tonight. Appreciate it.
Thanks.
Well, a few days after Netflix announced that largest price hike in its history, it reported a mixed quarter. Earnings out after the bell tonight were better than expected, but revenue was a little light. Here are the numbers that we got late today. Netflix earned 30 cents a share, 6 cents better than estimates. Revenue was up 27% from a year ago, but analysts were looking for more, and that sent the stock lower in initial after-hours trading tonight. Julia Borston has the one takeaway for investors.
Netflix giving more details of its massive reach. On top of announcing record paid membership growth, adding 8.8 million paying subscribers worldwide, the company giving a sense for the very first time of how many people are watching its shows around the world. The company saying it estimates that over 80 million member households will watch Bird Box, starring Sandra Bullock, in its first 4 weeks on the platform. Also talking about the company's global hits, saying Spanish language original Elite has been viewed by over 20 million member households in its first 4 weeks. The company also projecting that 2 new series, You and Sex Education, will be watched by over 40 million households in their first month. Against the revelation of these massive numbers, CEO Reed Hastings talking about competition, saying it's not just competing with similar subscription streaming services such as HBO, but more so competing with video game Fortnite as well as YouTube. Hastings saying that with all this competition, Netflix's focus remains on improving its content. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Also out after the bell tonight, Dow component American Express reported record revenue as more people used its credit cards and charged more. The CEO said that growth was broad-based and that the company is seeing good returns on its investments, but earnings were not as strong as hoped for, and investors sent that stock initially lower in after-hours trading tonight. And then there's Morgan Stanley, which many say was the most disappointing bank earnings report this week. Both profit and revenue came in below expectations because its 2 biggest businesses, trading and wealth management, suffered declines amid what it called a difficult market environment. But on the earnings conference call today, CEO James Gorman said the most recent quarter is not indicative of things to come.
We do not believe the fourth quarter is a new normal. In fact, while it's early days, the first quarter has started on a similar path to the start of the first quarter of 2018.
But shares of Morgan Stanley did fall 4% in today's session. Elsewhere, the State Department today recalled most of its furloughed workers and said it is taking steps to pay salaries despite the partial government shutdown. Other agencies have also recalled some of their workers as well, but without pay. And they did so by expanding the definition of essential services. Contessa Brewer has more on that from Hackettstown, New Jersey tonight.
After 27 days of a partial federal government shutdown, the doors of the Farm Service Agency opened once again. But for 3 days only. The FSA provides crop insurance and serves as a lender of last resort for farmers on the brink of going belly up. Farmers like George Fetzer.
I lost $40,000 retail, and for a small guy like me, I can't afford that. And all I wanted to do was get a loan to pay my bills off.
Fetzer expected to close on his loan in December, but the shutdown prevented him from getting the final paperwork. And so, as Agriculture Secretary Sonny Perdue ordered 2,500 employees to open half the FSA offices around the country for very limited services, farmer George Fetzer showed up to see if he could push through his loan. But no such luck.
I cannot get my money because I don't have the funding in place.
Nationwide, other agencies are also bringing back furloughed employees.
Aviation safety is a priority and should remain a priority.
3,600 safety inspectors for the FAA have been recalled to their jobs. The FDA is bringing back 400 inspectors to check high-risk foods, medicine, and medical devices. And the IRS will bring back half its workforce, or 46,000 employees, to help issue tax refunds. None of these workers will get paid. Air traffic controllers and other employees sued the Trump administration over mandatory work without pay. A U.S. district judge this week declined to rule on the issue and declined to give employees the right to sit out if they choose. In the meantime, other federal agencies are beginning to run out of money. The federal court system, including the Supreme Court, can only sustain funded operations through January 25th. And civilian businesses are beginning to see an impact from the government shutdown, too. Some farmers who were getting payments to mitigate the financial damage from tariffs and the trade war haven't received their checks.
I see how this has affected me, but all these people that this whole shutdown has affected, it's just like people's lives are getting ruined over this.
As more federal employees are punching the clock again, even as the shutdown barrels on, a new bill signed by President Trump now guarantees back pay for the 800,000 employees who've been forced off their jobs. In Hackettstown, New Jersey, Contessa Brewer, Nightly Business Report.
Time to take a look at some of today's upgrades and downgrades. We begin with Dow component Walgreens Boots Alliance, which was given a sell rating in new coverage at UBS. The analyst there says the company's core retail margins will remain under pressure over the next several years. Price target now $70, and the shares there fell 1 penny to $71.99. Chipotle was downgraded to hold from buy at Maxim Group. The analyst says that any positive news is now factored into that stock, given its 30% gain since late December. Price target $510, and shares today rose along with the broader market to $517.66. Still ahead, Airbus deepens its ties to the Deep South. Shares of missile and weapons makers rose today after President Trump announced the results of a missile defense review and rolled out his plan to ramp up the system's capabilities. This would be the first update to that program since the Obama administration back in 2010.
Our review calls for 20 new ground-based interceptors at Fort Greely, Alaska, and new radars and sensors to immediately detect foreign missiles launched against our great nation. We are committed to establishing a missile defense program that can shield every city in the United States.
The review recommends studying space-based weaponry, and it did single out North Korea as an ongoing threat. That sends shares of Northrop Grumman, Lockheed, and Raytheon all higher in today's trade. Meanwhile, the growing importance of the Deep South to America's aviation industry is getting a big boost. Europe's Airbus is expanding its manufacturing plant in Mobile, Alabama. Phil LeBeau has more on this newest commercial airplanes that will soon be flying out of the southeastern United States.
With fireworks and applause, Airbus executives and political leaders broke ground on new assembly lines in Mobile, Alabama, where Airbus's newest plane, the A220, will eventually be built, adding 400 jobs, more than doubling the number of people currently working at the plant.
We didn't come here because you are just nice people. We made the decision because we were convinced it was for the good of Airbus going forward.
Airbus opened its first plant in Alabama 4 years ago in hopes it would help the European company win more military and commercial plane orders in the U.S. And that's happening with its new plane, previously known as the Bombardier C Series, which will seat up to 150 passengers. This move also reinforces just how important the southeastern U.S. has become for commercial aviation. Boeing's plant in Charleston, South Carolina, where they build the 787 Dreamliner, now employs more than 6,500 workers. While there's no expectation the plane-building hubs outside Seattle, Washington, or Toulouse, France, will ever be replaced, Boeing and Airbus have clearly spread out their footprints. And both footprints, along with manufacturing jobs, continue to grow in the Deep South. The Airbus plant in Alabama is scheduled to roll out its first all-new A220 by the middle of next year. Phil LeBeau, Nightly Business Report, Chicago.
Signet Jewelers loses its sheen, and how, and that's where we begin tonight's market focus, with the company cutting its profit and sales guidance following slower than expected holiday sales. It also hinted that it could close more stores as a way to improve profitability, but shares plunged by 24% today to $25.13. Industrial company PPG issued a weak outlook, citing a softening global economy and declines for its products in some countries. The company is also considering splitting up its building and products coatings unit following pressure from an activist investor. The stock rose more than 4.5% today to $107.36. Construction supply company Fastenal easily topped Wall Street revenue forecasts. Its results were helped by stronger demand, but it gave only modest signs that it's been able to push through higher pricing. Fastenal's results were often seen as a gauge of the health of the broader manufacturing sector, and that stock was up nearly 6% today to $57.34. Regional bank BB&T topped the Wall Street estimates thanks to higher revenues and a decline in costs. Loans and deposit balances improved during the quarter, and the company's CEO says that should continue.
Our business activity was strong in the fourth. Everything we see now would suggest that it will be strong on a seasonally adjusted basis through the first. So there's no real reason today to be concerned about business activity.
The stock gained 1.5% today to $48.28. Back when the tax law was passed more than a year ago, many thought that there would be a migration from high tax states to lower tax states because the legislation limited deductions for state and local taxes, including property taxes, to $10,000. And more than a year later, that appears to be exactly what is happening, especially for the wealthy. Robert Frank takes a look now at the millionaire migration.
A new report out today shows the South Florida real estate market shining bright, while the Northeast is facing a long market chill. Average sale prices up 7% in Miami and up 20% in Boca Raton. Fort Lauderdale, Palm Beach, and Wellington also posting solid numbers for the fourth quarter. That's according to a report from Douglas Elliman and Miller Samuel. Now, Florida brokers say it has been the strongest start to a winter selling season in years. But Manhattan just finished its worst year since the financial crisis. Greenwich, Connecticut, once home to all those hedge fund billionaires, well, it is now filled with empty mansions. Prices there falling 20% in the quarter, and there is now a 2.5-year supply of luxury homes. So why the tale of two markets? Well, taxes are one big reason. The new tax law, which limits the amount of state and local taxes you can deduct, makes it more expensive now to live and own in New York and other high-tax states.
A business owner making $1 million a year will actually be saving enough money in taxes to support a $2 million mortgage on a condo in Miami.
Demographics is another reason. The population is getting older, and many want to retire in Florida. Developers are responding with ever more elaborate and luxurious buildings in the Sunshine State to lure those migrating millionaires. Desert Development just finished the Porsche Tower, which has a glass elevator to bring your car to your apartment. And it's now finishing the Armani Casa, where you can have your wardrobe and your entire apartment designed by Armani. And more high-end development is likely as the builders follow the money. For Nightly Business Report, I'm Robert Frank.
Coming up, could extreme weather trigger the next foreclosure crisis? Les Moonves is not giving up without a fight. According to a regulatory filing, the former CBS CEO is demanding binding arbitration following the company's board's decision that he was fired for cause and therefore not entitled to $120 million in severance payments. Moonves was ousted last fall following multiple allegations of sexual misconduct. He has denied any wrongdoing. Microsoft announced today it is investing $500 million to tackle Seattle's housing crisis. The company says the money will go toward building new homes and preserving existing housing in an effort to increase affordability for local residents. But Microsoft added its role is only part of the solution.
We need market incentives. We need zoning changes. We need to incentivize lower and middle income housing. We need capital. We're bringing capital to the table. Different solutions may make sense for different communities or for different companies.
Microsoft pointed out that in Seattle, the local median income has not kept pace with rising housing costs. Finally tonight, a new government report warns climate change will cost the U.S. economy hundreds of billions of dollars in annual losses by the end of the century. From floods to droughts, the threat of extreme weather to homes is certainly clear, but the risk to the mortgage market is just now coming into focus. Diana Olick has the next installment of her series called Rising Risks.
Hurricane Harvey flooded close to 100,000 Houston area homes, and the vast majority of them had no flood insurance.
Ultimately ended up about 4 feet.
Jennifer and Andy Taylor did have insurance and at the time vowed to rebuild.
The fabric of the community has been amazing.
But as they watched several homes on their street go into foreclosure and the fabric of their community seemed to unravel, the Taylors joined other struggling neighbors and sold to hungry investors who descended on the city.
We have sold.
Houston's strong economy made it a hot housing market before the storm, and investors are still swarming foreclosure auctions like this one now, rekindling images from the foreclosure crisis a decade ago.
I've heard plenty of stories of homeowners who had no choice but to walk away.
In Harvey's federally declared disaster areas, 80% of the homes had no flood insurance because they weren't normally prone to flooding. Serious mortgage delinquencies on damaged homes jumped more than 200%, according to CoreLogic. Houston could have seen a massive foreclosure crisis were it not for that strong investor demand. The next city to get hit by a natural disaster might not be so lucky. In Houston, investor purchases of 10 or more properties jumped nearly 50% in the year following Harvey, according to Atom Data Solutions. Some were large buyers like Cerberus Capital and Homevestors. Others were smaller home flippers like J.P. Patel.
As an investor, I mean, it was kind of a perfect opportunity.
Patel and his team have bought more than 80 flooded properties so far.
We literally can avoid the whole problematic nature of the foreclosure process.
And it's not over yet.
Even a year after Harvey, neighborhoods like this one are still rebuilding, littered with empty houses and empty lots. Some say all of this should be a wake-up call to the nation's banks and mortgage lenders.
We asked Ed Delgado, the CEO of a mortgage industry trade association, if the mortgage market is prepared for increasingly severe weather.
I don't think they are. I think if we look at the basic foundation of what drives the mortgage market is the application of credit risk. What's missing is the understanding of weather risk and where those weather events can take place.
Delgado emphasized that most of the damaged homes in Houston were not in FEMA floodplains.
Well, you have this tremendous urbanization, population growth, roads that are being built in the last 10 years. Where does the water go? And is there an underlying risk for us to examine with respect to our portfolio? And then make decisions. Should we be lending in those markets?
Lenders today and the federal government that backs most loans base their risk on FEMA's flood maps. But even top FEMA officials admit their maps don't account for increasingly extreme weather. David Morstead leads risk management at FEMA.
We can't try to determine what's going to happen in 12 months beyond, because insurance is set up for what your risk is today. And it wouldn't meet actuarial science to charge you for a future potential.
FEMA is required to update its maps every 5 years, and Morstad says it relies heavily on local communities reporting problems. But some don't, because they don't want their insurance premiums to go up.
We know that only 1/3 of the properties in the high-risk area have flood insurance, so we have a lot of work to do.
As does the mortgage industry, which could ultimately see a climate foreclosure crisis.
I think it could come close in terms of exposing lenders to uncontrollable risk. When you have $1 trillion of real estate at risk in coastal markets, it's about time you start paying attention to that.
For Nightly Business Report, I'm Diana Olick in Houston.
Thanks for watching tonight. We'll see you tomorrow.